All right. Well, good morning and good afternoon to some of you. Thank you for joining us. We are about to get started here on our Wheelhouse webinar. Thank you so much for joining us. I do want to let everyone know that we are recording this session. So please note that this is being recorded. My name is Angela Gomez. I'm the National Director of Development here at Free Wheelchair Mission. And just very grateful for this opportunity to share this very important topic with all of you. So thank you for giving us this time. And as I said, we'll be recording it. So we will be sharing this webinar with everyone afterwards so that you can go back and review it and or share it with whomever you'd like to share it with. At this time, I just want to say thank you. We have some really wonderful panelists that have given us their time today to be able to talk about this very important topic here about planned giving, legacy giving. So I want to take this moment to give them each an opportunity to introduce themselves and share a little bit about their background and Free Wheelchair Mission. So I'm going to go ahead and get started with Julie.
Hello, everyone, and thank you, Angela. My name is Julie Cho. I'm the principal attorney of Cho Law Firm in Irvine, California. I'm an estate planning attorney, so that means I prepare wills and trusts for my clients. My typical client can be your average Orange County family. It doesn't need to be high net worth. And we're gonna, I help them with avoiding probate, making sure that all of their distribution desires are met, and also do some charitable planning and estate tax planning. And I'm happy to be here with the Free Wheelchair Mission. I was introduced to it through Dana Heineman, who is the National Ambassador Manager through the Irvine Chamber of Commerce. And she had told me about this organization. I love that it's faith-based, and I love just the overall good work that it does. So I use it as a thank you gift to a lot of my clients, and I love to contribute to it. And I'm so happy to be part of this webinar. So thank you.
Oh, thank you, Julie. Appreciate your support in various different ways. I'm really grateful to have you here. And next, I introduce Mr. Doug Hyepock.
Perfect. Good morning. Good to see everyone. My name is Doug Hyepock, and I'm a managing partner, financial advisor with J. Derrick Lewis and Associates, an investment advisory firm in Newport Beach. Grateful to be here this morning. Our association with Free Wheelchair Mission goes back to around the year 2001. I was a part of the National Christian Foundation, and I remember Dawn coming into our offices with the first prototype chair, the white chair, and then a yellow pad with this vision for what ultimately became the Free Wheelchair Mission. I mean, so it's amazing, unique to see something come from infancy and an idea to just an amazing ministry that touches countless lives. So grateful to be here, grateful to share a bit with you today on some strategies to really help maximize your giving and to advance the work of Free Wheelchair Mission.
Wonderful. Thank you, Doug. And last but not least, Mr. Peter Liefer.
So I came across Free Wheelchair Mission about 3 years ago. One of my friends was very much involved, and I respected her good judgment. And as it turns out, 50 plus years ago today, I was commissioned as a second lieutenant in the United States Army. And a short time later, I found myself roaming around Vietnam. So I went back with Angela with Free Wheelchair Mission probably 2 years ago, a little bit, during the hottest May ever recorded in Vietnam. And we gave away a number of wheelchairs. Talking to people who used to try to shoot me, and I used to try to shoot them. So it was a very moving experience. I have been a financial advisor for several decades. Real focus in my life is the charitable area and how to use the tax laws to make a difference. That's really the focus I've had, and that'll be the focus I have for a number of decades, all going well. So there we are. Thank you.
Oh, thank you, Peter. Really grateful to all three of you for joining us. And, I want to get us started just to get the conversation and ideas going with a short little poll that we have put together here, just some questions that we want everyone to consider and ponder and ask that they may not have thought about before. So, as you can see there on your screen, do you have legacy gifts planned? That's something that you can respond to there. Perhaps some of you are looking to find out what is a legacy gift. We've heard a lot about legacy giving or planned giving, but this is something that we won't be covering today. So you can see there that there is a large percentage of folks that do not have it, do not have something laid out, which hopefully by the end of our session today, you'll get a little more understanding and want to learn a little bit more about what this is all about. So this is just going to lead us straight into the questions that we have for our panelists, because as I said, as all of us are thinking about how we can leave our plans, think about ways of giving creatively to your favorite charities, and also just having these conversations with your loved ones about what you want your legacy to be. We will start this off with this very, very important question. And this is directed to Peter. Peter, what is a legacy gift?
It's often very confusing. And what happens, let me start with one of the main problems is when we talk about philanthropy. One of the things that comes up is everybody instinctively says, gee, I don't have enough money to be a philanthropist. No matter how much money they have, it's always someone else. So the legacy gift is really defining, how do you want to be remembered? How do you want to be thought of when you pass with your family or your community? Legacy then is often the bequest. What happens with the will? What happens with the trust? How money or your assets are distributed after your passing? I try to encourage people to think of themselves as being generous. And what is the legacy that you're doing now during your lifetime? And how are you being thought of in that way? So to shift that slightly, we're going to be talking about a number of great tools. But if you want a place to start, there's something as simple as something called a donor advised fund. It's very, very common. And in my household, Thanksgiving will come up like you in a few weeks. Today, we have fall beginning. So we know Thanksgiving is not that far. Catherine, my wife, who spent her career in the nonprofit area, before Thanksgiving, we let our kids know. She has children, I have children, that on Thanksgiving, we want them to be thinking about where do they want to be making a gift. And the grandsons are as young as 8. So we're sort of encouraging them to think about where do you want to make a difference? How do you want to take care of people? We have a great dog in the family, which came from a shelter. That might be a way to do it. People know, my community knows that we went to free wheelchair missions. So free wheelchair mission knows, we went to Vietnam, a free wheelchair mission. People know that that's where we're going to give gifts. So think about legacy giving with how are you going to be thought about? What did you do before you died? Angela, there you are.
Okay, great. So a legacy gift, some of the questions we've received is, for example, what is a QCD? So in what we have learned is that's something that I'd love Doug to be able to explain. What is a qualified charitable distribution, and how can I use my IRA to benefit Free Wheelchair Mission? If you can elaborate a little bit more on that.
Sure. So like you said, Angela, QCD stands for Qualified Charitable Distribution. And as you probably know, I mean, millions of savers have pre-tax IRAs out there that represent monies that either they've put away each year on a tax-deductible basis or perhaps rolled over from former retirement plans from 401ks, 403bs, and so forth. But there's a unique way for the right person, for the right giver to use those traditional IRA monies to really benefit ministry, charities, Free Wheelchair Mission, whatever they have in mind. Essentially, there's 2 smart tax tips. One is to use that IRA income to make charitable gifts. And then secondly, to name a public charity like Free Wheelchair Mission as the beneficiary. So I'll kind of dive briefly into both of those 2. The charitable IRA rollover, it's a way to increase your tax savings as compared to just writing a check to charity. And so with the passage of the Secure Act, At age 72 now, everyone has to, if you have a pre-tax IRA, you have to begin required minimum distributions. It formerly was 70 and a half. So everyone, once you hit that 70 window, you have to start taking money out of pre-tax IRA accounts. Well, those distributions, if you take money out of a pre-tax IRA account, it results in ordinary income taxes and potentially pushes the IRA owner into higher marginal tax rates. And so further, additional IRA distributions can affect things like Social Security taxability, Medicare and Medicare benefits, and so on. So really, for the charitably minded retiree, that QCD is a great tool, because what the IRS allows you, permits you to do, starting age 70 and a half, you can distribute up to $100,000 per year to qualified charities or a qualified charity. So again, up to $100,000 a year once you hit 70 and a half. So it's a wonderful tool, and I consider it, in terms of charitable strategies, it's kind of one of those layup strategies where if you're in that bandwidth and you're forced to take out distributions, it's just a great way to do it, because the money goes directly to charity. You don't have to report the distribution on your 1040 as taxable income. And so there's no additional taxes you owe. And because Free Will Chair Mission, as an example, is an exempt entity, they don't pay any tax on the distribution either. So it's just a great way to leverage the tax rules to your favor, and again to advance your charitable objectives. So it's a win-win. It's a win for you, and that you don't have to report it as income. It's a win for Free Will Chair Mission because they don't pay taxes on the distribution either. So the net effect is, it reduces your taxable income if you're subject to RMDs, required minimum distributions. It provides a greater tax benefit, most likely because of you're not phased out or limited on other deductions that you might have, or even Medicare and Social Security taxation. An example might be, a person like Bob who's single, he's 73, and he's got ordinary income of $80,000. So he has to take his distribution each year. So let's say he's got $1 million IRA and he has to take out about $40,000 a year. He could have those funds go directly to Free Will Chair Mission, doesn't have to claim it on his tax return. And then again, Free Will Chair Mission uses that to advance their objectives. The checks go directly to the charity. So that's one way. Again, the QCD for the right person over 70 and a half that's forced to take IRA distributions each year. The other way to really maximize use of your IRA for the benefit of Free Will Chair Mission is naming the beneficiary of your traditional IRA, a charity like Free Will Chair Mission as the beneficiary of your IRA. Public charities are exempt entities, like I mentioned, therefore they don't pay taxes. In one's passing, all those IRA monies can go directly to the charity, no tax, no penalty, no problem. And so again, it's a great way to support your charitable objectives, specifically even those that don't have spousal beneficiaries. So let's say, for example, you've got adult children who would otherwise be named as beneficiaries because your spouse is deceased or you don't have a spouse. Well, under the new rules, they, as non-spousal beneficiaries, now have to distribute those IRA funds within 10 years. And in many cases, the income beneficiaries are still working, and therefore those distributions are taxed at their highest marginal rate. It just gets lumped on top of their current income. Well, a great way for charitably minded folks is to distribute those funds to charity, because again, no tax, no penalty, and no problem in that way. So it's a great way to minimize. It's a win-win. It takes the IRS out of the picture, the state out of the picture, and then again, really advances your charitable objectives. We had a client just last year, passed away, $1 million retirement account, and the family was fine in terms of having sufficient resources. Instead of the government potentially taking maybe half of it, all of it went to charity. So again, I would just say that's a pretty effective and smart way to give both the qualified charitable distribution for those over 70 and a half, and then again, easy layup, naming the charity as at least a partial interest beneficiary in your IRA account. Back to you.
Thank you so much, Doug. Yes, and I will say over the years here at Free Will True Mission, we just celebrated in April our 20th anniversary. We've been definitely blessed by receiving gifts of this nature. I would love to see that be more, especially with some of our supporters where with this pandemic and with life circumstances that occur, we're not always necessarily asking for anyone to utilize their cash resources at the moment, but think creatively of other ways that they can give to Free Will True Mission. And so we put it there on the chat on our website, freewilltruemission.org/legacy giving. We do have more information on some of this. And of course, we'll be sharing contact information at the end where we can go deeper into these topics if you have further questions. So the next question I want to take us to is to Julie. So Julie, what are the most used split interest charitable trusts? What is that all about?
So charitable trusts are another powerful way of taking advantage of tax savings. Generally speaking, a charitable trust is an irrevocable trust that's created for a charitable purpose. It can provide income tax benefits, gift tax benefits, as well as estate taxes. In terms of the estate taxes, whatever asset you put into the charitable trust is completely taken out of your total estate. So you're going to save on any type of estate taxes that you might be exposed to. The most commonly used ones are split interest charitable trusts, and there are two of those. The first one is called a charitable remainder trust, or CRT. This other one is called a charitable lead trust, or CLT. They're more or less the same. It's just a matter of who gets the income first and who gets the remainder. So in a charitable remainder trust, the charitable remainder trust distributes the trust assets at least annually to a non-charitable beneficiary. So if you've got children, they're going to get the income stream from the trust assets that's put in the trust. Then upon the term expiring, or the termination of this, term, whether it's 20 years or, the grantor's life, then the remainder or what's left over goes to the charities such as the Free Will True Mission. So at the by doing this, there's income tax, charitable deductions, and then again, there's estate tax benefits as well. So and because the CRT is a tax exempt entity, there's no income taxes, much like what Doug was saying earlier about what's transferred to the charity. When let's say there's real property that's transferred over to the trust, and the trust then sells it, or that charity sells it upon receiving it, and there's a high increase in market value, there is no income tax that the charity pays, whereas individuals could be subject to it. So there's a lot of tax benefits to this. The charitable lead trust, it's the orders flip-flop. So basically, you name a charity that gets the annual distributions or the income from the trust, and then upon a specified term expiring, then it's distributed to a non-charitable beneficiary. So then it could go to your child or aunt, uncle, whoever you might want it to be. Then the maker of the trust, or it's called the grantor, the settlor of the trust, receives an income tax charitable deduction, and you also receive the current income deduction on the income interest that goes to the charity. So there's a lot of powerful tax benefits to it, but the way that it works is essentially set up that way. And I think we've got Peter, who's got some nice slides that can kind of help you with the visual and give some examples too as to how he's seen these being used. So Peter, if you can go ahead and share your screen.
Yes.
Yeah.
Okay, good. So quick idea. I'm going to go back and just touch on it, but apply it on the ground. And I'm a visual person and I'm a storyteller. So let me just tell you an example of how this works. In order for a charitable remainder trust to be something that you should consider, we need you, okay? And you have to have some charitable intent, a certain amount of generosity in your soul, because that has to happen because you're giving up some assets. So you're going to take the assets that you have a taxable event in your life going on, and you're going to share more of your money with the California and state and the federal government than you would like to. Here's how we take care of this. Someone like Julie will set up for you a trust document. Your assets that you have will go into the trust, as she mentioned. Income will flow to your family. On your passing or at the end of the beneficiaries, it goes to charity. Here's the story that goes along with it. I have two clients named Sandy and Tony. Tony was a very successful young tech guy many, many years ago, was one of the early pioneers around the pacemaker business. His company got bought out. That company got bought out. And pretty soon, Tony was a very, very wealthy man. So his CPA suggested that we set up a charitable remainder trust. Introduced him to a good attorney that I worked with here in Arizona. We drew up the documents. We put in several shares of that company, which happened to be Eli Lilly at that time, a couple hundred shares. Substantial tax write-off. It worked really well for them. Cash flowed to them on a yearly basis. They didn't really need the money, but it came. Tony died suddenly. Sandy, his wife, continued to receive the money, but we had a second conversation. We said, well, you don't need the money. What should we do with this? Sandy started using the money to buy, she was healthy, bought a life insurance policy, which was owned by the university that her husband went to. Every year, she would send off the money that came to her out of the trust to the university. They would make the life insurance premiums. And when Sandy passed, $1 million would end up going from the life insurance proceeds. The charitable trust continues to go on, and she still has money to give away. We have fully funded the life insurance policy. And when she passes, which I hope is not soon, because she's one of the more charming people I know, the money will go to a church organization that she feels that's important to her. So that's a charitable remainder trust. Julie, anything, I took a really high view. Anything I missed that's really important there?
No, not at all. That's great.
Okay, I'm going to flip over to the charitable lead trust. Okay. Gee, that looks just like the other one, doesn't it? Because it has the same pieces. It's just a matter of how do we use them. Once again, you or your family, you have a charitable intent and you have a one-time occasion in your life. Usually you have more money than you know what to do with. And so the government knows that, and they are going to extract a large amount of that. What do? A trust is established by Julie. Asset goes into that. Here's the difference. The money now from that goes to the charity first. You get the tax write-off. You get to use it in years that if you don't use all of it, you can continue it in years going forward. So how do you use this? Where's a good example? This is really great for people who are younger. And a case that I'm involved in Northern California, a young lady, we'll call her Ashla, went to work for a small technology company when she was 25. And a short time there, they realized she was pretty smart. And they kept promoting her. And by the time she's 42, she's now been there, if my math is right, 17 years. And in order to keep her, they kept giving her stock options. And Ashla and her husband, Mike, and he's a school teacher, together they're used to making about $125,000, $130,000 a year. Suddenly the company is bought out and she has $3 million. And she's in California. So she's pretty comfortable that her CPA sits down and says, yeah, you're going to give up about a third to a half of that in your tax bracket. So what do? We put it in the trust, run some numbers, and they're not that complicated. So I'm just going to give you some quick overview. A decision is made to put $1 million in the trust to give 6% a year of that $1 million to charity. It can be to Free Wheelchair Mission. It can be to their own donor advised fund, but they're going to do that for 16 years. 16 times 6 comes close to 100. So all of the $1 million is tax deductible. Okay, shelter is a substantial part of the tax bill. They get to be philanthropists when they're young, and 16 years plus they're 42, when they're in their late 50s, the $1 million or how much it's grown to, or being a good advisor, it may have gone down, but it'll go. Doug and I would work very hard to make sure the $1 million would have grown. Money has gone to the charity over that period of time, and the money comes back. This is a tool that is not being used a lot, and it should be. Your classic people that I'm talking to, in my world, I happen to know a number of Bitcoin millionaires. They're younger people often. They bought Bitcoin, or they're the mothers of younger people who bought Bitcoin. And now suddenly that small investment is a big, big investment. How do we get out of it with a huge tax bill? In your world, in my world here in Phoenix, a lot of real estate people and mortgage people have made a whole lot more money than they're used to. They've taken advantage from good planning with their pension plans, and they've taken all the write-offs, and they're still having a huge bill. This is a tool that people can set aside excessive money that they've earned on a one-time basis or on a recurring basis, and fine-tune it to really serve their tax purposes. Julie, anything I should add?
Yes, and I think it's great, absolutely, on the tax purpose too. But in terms of just overall estate planning, it's, I think, very important for individuals or couples to set up these trusts so that their legacy and their desires are met, and there's no issue or any kind of contest that might be happening, after they pass. And the real the benefit of using these charitable trusts is that you set them up during your lifetime, and you reap some benefits of it one way or the other during your lifetime, and your intention is pretty clear, and it's going to be very difficult to have that disputed. So, in the overall idea of, set up an estate plan so that your desires, your wishes are clear. But in the same way, in terms of, a lot of us with estate planning, it's to set up your legacy, whether it's with charitable giving or through your children or, work, whatever it might be. It's a lot of it is just, making sure that your desires are fulfilled and not challenged.
Yeah. And I would add, Julie and Doug and I have had enough experiences, unfortunately, where that was not communicated to the family, and family members don't talk to one another, or if they do, it's through a lawyer, and it's an unfortunate mess. So get really clear about what your legacy is, and your legacy should not be you destroyed your family because you wouldn't do the estate planning that was important. Angela, there we are.
And I think, and one last point I just want to add too is sometimes clients don't know that they have the option to do this, or people just don't know that. They think, I've got 2 children, it's going to naturally just go 50-50 between my 2 children. But I think just, I like to educate people on the different options that are out there. And this is just something, when I do bring it up with my clients, they're like, oh, their eyes open up. It's like, oh, this is a great way to, continue my legacy in another way. So that's all. Thanks, Angela.
Great. Thank you so much, Peter and Julie. That was really, really insightful. A lot of content there. We definitely, at the end, we can have some more question and answer opportunities there, but I want to go into another topic here with Doug. Doug, can you give us some example of benefits of giving appreciated securities?
Sure, absolutely. Yeah, I would consider this another one of those kind of layup or easier ways to gift charitably, to really maximize the current tax laws, as well as, again, really benefit a group like Free Wheelchair Mission. Particularly as we're ending here or heading to the 4th quarter of the year, most people kind of revisit their charitable strategies. They want to take advantage of any gifts before December 31st, because that's when you have to make gifts by for the year 2021. And when you look at just the nice rally we've had in equity markets, stock markets, really for the last decade, I mean, it's been a pretty amazing term. And so many people in taxable accounts in their living trusts or just personally owned are sitting on pretty substantial gains in either stock or stock mutual funds. And you see a lot of cases where they're up 100%. So they've got a huge gain. So the challenge here would be for those people who are charitably inclined, who are typically writing checks to charity, maybe a better solution would be to gift some of those appreciated securities. And I'll build the case for that just briefly here, because the current law permits a giver to deduct up to 30% of their adjusted gross income using long-term capital assets or appreciated assets. And then any gifts in excess of that can be carried forward 5 years. So again, just to revisit that idea, if you have long-term capital assets, let's say you own Tesla stock as an illustration, with huge gains in it, you can gift that stock valued up to 30% of your adjusted gross income in the year 2021 and take a fair market value deduction. So this applies, these rules apply to, closely held stock, publicly traded securities, stocks, mutual funds, real estate, privately held businesses, anything that's, again, considered a long-term capital asset that's been held for at least a year. And for those who itemize their deductions, this would be considered an itemized deduction on Schedule A. And so here's the win-win in the picture is one, if you were to sell that asset, well, typically you're going to have to pay capital gain tax or potentially capital gain tax on the gains. By gifting it to charity, first, you eliminate what you would otherwise pay in capital gain tax. Secondly, you get a deduction of the fair market value versus what you paid for it. And then third, being Free Wheelchair Mission being a tax exempt entity, pays zero tax on any of the gains. So truly, they sell that stock or that appreciated asset, and all of it goes to advance the mission of the organization. So that's key. And so key candidates: publicly traded stock, restricted stock, real estate, privately held business interests, and any other long-term capital assets. And they're relatively easy to gift. So even in speaking, you can communicate with Angela to say, okay, I've got an account at Schwab or Fidelity or American Funds. It's a simple electronic transfer of those shares over. It can be done within the course of several days. So even for those that procrastinate and wait till December, there's still sufficient time to take advantage of those types of gifts. I know for us personally, my family, we don't write checks anymore to charity. We give appreciated securities because it's just a smart way to minimize tax and to really leverage the current tax rules to have more going to charity. A couple of examples of real estate I can think of one where a family had an undeveloped parcel of land, multiple acres that they intended to build on but never did, yet the appreciation on the property was substantial. So they elected to gift that property to a charity. They received a tax deduction for the full fair market value, up to 30% of their AGI, and then they carried the deduction over for future years. Another one was an apartment building, similar thing. I mean, these are a little more complicated than gifting stock or mutual fund shares, but for the right person, it does make a lot of sense. And those gifts can be pretty substantial, and the tax savings pretty substantial. And then taking it again, another layer or another level of complexity, with all the merger and acquisition activity that we've seen in the last few years, there are quite a number of people who have interest in closely held companies that have sold those companies. Well, with some prudent advanced planning, to take a part of that closely held company and gift, again, can yield, in some cases, millions of dollars of tax savings. So that would be, in terms of the order of complexity, I would say easiest in the layup, stock and mutual funds, then going to things like real estate, and then closely held business interests. So again, a win-win-win. You get the fair market value deduction. It cuts the IRS in the state of California for a California taxpayer out of the picture. And then again, 100% of the asset goes to advance your charitable objectives.
Yeah. Thank you, Doug. We want to remind everyone, please, if you have any questions for any of our panelists, please include them there in the chat. You can just type them in there and I'll read them out loud and get them there. We did have a question a little earlier. Perhaps this was to you, Julie. Are there benefits to putting cash in a CRT? If real estate is put into a CRT, what happens if you sell the property? Which I think was slightly addressed already, but if you want to just go into a little deeper in that. If you can unmute yourself.
Yes, I see it. So in terms of the cash, the benefit of putting cash or any asset into a CRT is that, depending on the amount, you'll get the tax benefits to it. So, whether it's cash or stocks or real estate, there's always a benefit to it. In terms of real estate, whether you can sell it or not, that would be, what was the question exactly? Whether you could or couldn't sell it? I think.
Yeah, the question was real estate is put, if a real estate is put into a CRT, what happens if you sell the property?
Right. So it's really you sell it and you don't buy another property, then it's the cash is then held by the trust. So just remember that when you transfer an asset or cash into a revocable, into a CRT or a CLT, that you're giving up ownership of it. So then the trustee is the one who's managing it. So whether if that asset is sold, then that money or the proceeds of it is still held by the trust. If that property is sold and another property is purchased, it's still owned by the trust. It doesn't come back to you as the grantor. It's held by the trust for the benefit of the charitable, of the charity, as well as the non-charitable beneficiary.
Got it. Okay, thank you. We have a couple of more questions here. Let me make sure I address this one. Do you need to provide anything other than the name of Free Wheelchair Mission when you list a beneficiary? Maybe this is to you, Julie.
This is, yes, you really want to get the direction from that charity that you want to give it to. So in the case of the Free Wheelchair Mission, you reach out to them, the donor department, Angela, I'm sure you can direct them, but it says in there exactly what the name of it is, because you want to make sure that the legal name of the 501c3 or the qualified entity is correct.
Okay, yes, and that's true. We do have that. Actually, you can speak with anyone on our team. We also have it listed on our website too. Some of the questions we've received is, how do you list Free Wheelchair Mission? So we included some simple wording on our website, again, that you can see there, but definitely happy to provide you the detailed information. So I do have another question that we wanted, Julie, for you to cover. What are some important changes to the tax landscape?
So the taxes, what I want to talk about is the state tax limit, because that's what is potentially going to be changing. The state tax limit is essentially what your estate would potentially be paying if it went over a certain value in terms of net value. So currently it's $11.7 million per person. The average American doesn't own $11.7 million in net assets, but for those, who are at that, let's say you've got $12 million, then the difference between that 12 million and the current estate tax limit, which is 11.7, is taxed. So the $300,000, that's the difference in a $12 million estate, it's going to get taxed at about 40%. So most of us are not subject to that limit, but what you need to consider, or what Americans should consider, is that this limit is going to sunset in December of 2025, and it's going to get reduced to half. So for people who might be around the 5.5 million mark, then you want to consider some estate tax planning. And so, for example, if you're at $7 million, then you want to think about maybe how can you give away or gift away, $1.5 million of your assets, so that that 1.5 million is not taxed at 40%. So some of the ways to do it is through the charitable trust that we had discussed earlier, because the assets that's put into those trusts are not included in the taxable estate. So, the automatic reduction is going to happen in 2025, unless, of course, Congress renews it. But the other thing to consider is that the Biden administration may be reducing that to even more. The proposed limit is $3.5 million roughly. So, for people then who have about $3.5 or $4 million in total taxable estate, you might want to consider doing some advanced planning and setting up various types of trusts to reduce your estate tax exposure. The other thing I want to touch upon real quick is that the proposed tax changes with the Biden administration is also on the income tax. So previously, if I'm the daughter and I inherit property from my parents, I get what's called a step-up basis. So the value of the property at their death, or the asset at their death, gets stepped up to that value. So when I sell it, I don't have to pay income taxes, or the income taxes is just from that stepped up basis to what I sell it at. But the proposed tax rules is considering eliminating that. And that's the case, then all of the income tax benefits that Doug was talking about earlier could be eliminated. Although, Doug, let me ask you real quick. I mean, but charities are probably still going to be excluded from that. Do you know at all?
Yeah, that's my understanding. Yes.
Yeah.
Mhm.
But so generally speaking, though, in terms of overall planning, then you might want to include the charities in your planning, but also think about other assets that you have that you might want to plan better to in the event that this new tax law gets passed.
Thank you. We are getting a few questions here. I'm going to ask this one perhaps to Peter. What are some of life changes, for example, marriage, children, work, et cetera, that may have the biggest impact on legacy giving?
Ask me in January when everything is passed or not passed. I think the biggest one in my world is the stepped up cost basis. Everybody tends to benefit from it. I get real estate. I just had a situation where we were doing elaborate planning and then my client died, and suddenly we could now go ahead and take money out of the IRA and use it differently. So there's so many of them. A lot of it is the income tax aspect. How will that affect your income if you are a high wage earner? But number two is if you have substantial assets, you may want to take a look at some of these devices we've talked a lot about this year, about charitable remainder trust, the charitable lead trust, and to get them into effect before the new tax laws could possibly go into effect. The things that are proposed will result in more taxes and not less taxes.
Mm-hmm. Okay. And what are a few, perhaps this to Doug, what are a few small ways to start, and when is the best time to start?
I would say that a couple just very easy, basic, but has significant impact is look at your beneficiaries of your retirement accounts, whether those be IRAs, 401k, 403b accounts, and just make sure those are current and consistent with your current objectives, because you see situations where really the beneficiaries no longer need the money because the beneficiaries haven't been updated for a decade, and the family potentially has charitable objectives. So including a group like Free Wheelchair Mission as at least a partial beneficiary of your retirement account, whether IRA or 401k, 10%, 50%, 100%, you can do whatever you want. I'd say that's an easy one that I would really encourage people, that we encourage clients to do. And then secondly, for those who are charitably inclined currently, who write a lot of checks for charity, I would say really explore if you have any appreciated stock or mutual fund shares. It's a very easy way to, again, maximize giving and really get a lot more bang for your buck by the deduction and avoidance of capital gain tax.
Okay, great.
If I can jump in on Doug and Julie, what they both have brought up, the horror stories you see is somebody sets up their trust. They set up a great trust, and then they don't change their beneficiaries on their IRA. They don't change their beneficiaries on their life insurance because they have a great trust. Direct beneficiaries override trust. And so if you have this wonderful trust and you haven't put assets inside of them, and when you refinance, usually the mortgage company will have you take your home out of the trust. They'll issue the loan in the couple's name, and then you don't put it back into the trust. So it's now out of the trust and there's probate. So there's a lot of landmines out there. Beware of the landmines, my Vietnam metaphor. So there we are.
Thank you. That's a great point. One question we got is, if I'm trying to avoid capital gains and also get a tax deduction for the gifts I do make, what kind of fund/trust would you recommend for me? Maybe this question is for Julie.
Sure. I think either of the charitable trusts that we had discussed would be appropriate. It really just kind of goes into what the amounts are, what your current financial situation is, and what your end goals are. So, it's difficult to say this is the best thing for you, but either of those trusts would be giving you those tax benefits that you want, as well as the donor advised
Yep.
funds too, Peter. So if you want to go into that a little bit.
May I hit the slide on that real quickly, Angela? And I will, I have been disabled. My screen sharing is disabled. So let's see if we can find it. I'm still disabled. Okay. Donor advised fund. It's your personal foundation. You can set it up with as little as $5,000. You can set it up online. And in both Arizona and California, what you really want to do, tax planning, if somebody who usually gives away $5,000 a year, just basic stuff, put a bigger amount together and spread it out over 3 or 4 years so you can really use the deduction, because under current tax laws, your small checks really don't lower your taxes. I'm getting complicated. Set up a donor advised fund, put your assets in there, begin your charitable legacy there. And then as you get more sophisticated and more planning, talk to Julie, talk to Doug, talk to me, and we'll give you another view.
Sure. Thank you for that. One thing that, I think across the board for a lot of folks is there a minimum, should you be a minimum age to set something up, a planned gift or a legacy gift, a certain amount of wealth that you should have before you even consider giving in everything that we've discussed? What have you found, perhaps, any of you? Peter, let's start with you, and if you can, all of you chime in here.
I just had that asked last night of somebody starting a nonprofit who I introduced to one of my larger, compassionate, charitable people. And if you have the intention, if you are generous, and if you have the modeling in your family about making gifts, I think that, again, your donor advised fund is the easiest, best place to start. And if it's your family, I would encourage you to model to them about the power of generosity and how to be smart givers. That's start and find a way of starting. That's what I would say.
Doug, anything to add there?
I think kind of like Peter said, I mean, I think of the scriptural example of the widow and the mite. So really, I mean, in a lot of ways, if someone is compelled to generosity, whether it's a lot or a little, I mean, it's a matter of the heart. And I would say, even if it's a little, start with a little, right? But if you're entrusted with a lot, probably a good idea to give a lot. So that would be my input.
Yeah, I agree with you both. I mean, you can't start too young. There's never too young of an age, and there's no amount that's too small. And so I was thinking the exact same example that you did, Doug, too. But I mean, I love the free wheelchair mission, though, because for less than $100, you're gifting someone with mobility. And so I've done this with my children. Say, well, this is, at the time, I can't remember, I think it was like $85 or something. I said, here, this is what we're going to do. We're going to contribute to it because, my kids are still young. And this is what we're doing for some people who are less privileged. And I think it's just a great way to, because you also, receive by gifting. So I think there's absolutely no minimum age or amount.
Agreed.
Thank you. I have a couple more questions here. What is the most common mistakes you see clients make in their legacy gifts that hasn't already been mentioned today?
That hasn't been mentioned.
I was going to say,
I think we mentioned a lot.
But I mean, to reiterate what Peter said earlier, it's the funding part. You don't have the trust or the charitable trust named as the proper beneficiary, or you don't even have it funded properly, or the trust isn't set up right. I guess we didn't really talk about that, but in terms of for any of the charitable trusts, for it to be qualified under the IRS to get all of the tax benefits, it has to meet certain requirements of it. It has to be a complete gift or a complete transfer, for example. So if the funding of the trust or the transfer of the assets isn't proper, then it will fail and you won't get the benefit that you want in terms of the tax purposes. Sure, the charity will ultimately get it, But it's more the tax benefits that's also so powerful that you're not going to be getting. So just make sure it's, the funding is important, and that it's actually drafted properly.
And the other part of that is, if you have blended families, and many of us do, beware, talk to your minister, talk to your psychologist. How do you make sure that everybody knows what's going on? Because if they didn't like each other at the beginning and there's money involved, it will get very, very nasty. So make sure it doesn't get nasty.
Yes,
And
thank you.
I just add two real quick ones, and each of them have to do with time and timing, where again, December 31st is pretty key, right? I've seen cases where people wait till the very end and things get busy at year end, and sometimes institutions can't complete a transfer if they're given a transfer request on December 28th. So that's one. And then secondly is really on the more complex end of the scale, where a closely held business owner is looking to sell their company. By not starting the charitable thinking early on, you can't have a prearranged sale whereby you're kind of gifting a part of your company after there's a signed agreement to sell your company. So really there's some advanced planning and thinking through it before you actually, if you're charitably inclined and you're selling a big interest, you want to think through that well in advance.
Thank you so much. On that note, one of the questions we got is, what are any considerations or opportunities you have if you are a small business owner?
Do you want me
Would like to take that one?
Go ahead, Doug.
Yeah, so I would say if you are an owner of a closely held company and you're looking to prospectively sell it in time, it's probably candidly beyond the scope of Free Will Chair Mission directly, but utilizing a gifting strategy with like the National Christian Foundation, the Orange County Community Foundation, be a couple of examples, where you can gift a portion of that closely held company before sale, receive a tax deduction for the fair market value. And then once that company is in fact sold and goes through the whole escrow process, now you've got potentially $5 million, $1 million, whatever that number is, in that donor advised fund, where then you can then gift to your favorite charities like Free Will Chair Mission. And so I've seen that done successfully quite a number of times. And again, usually in the case of a closely held company, the cost basis is very low. So when that owner sells, it's pretty much largely all taxable because of the low basis. And so it just makes perfect sense. And then in addition to that, some people set up, the typically wealthier people will set up private foundations as an example. Well, with the private foundation, you can't gift an interest in a closely held company and get a deduction for the full fair market value like you can when giving to a public charity like Free Will Chair Mission, Orange County Community Foundation, National Christian Foundation, which are public charities. So it's a little more complicated, but I would say that's a pretty great way for the right person.
I'm going to tack on one thing, two things. Start planning early and start finding your team. And as you talk to your team and you put them together, find out what they do around charitable giving themselves. Where's their heart? Where's their money? Where's their head? Because a lot of people who don't do any charitable giving themselves, this doesn't fit into their wheelhouse because this is not how they think. So that's just get your players together ahead of time.
Sure. We're coming short on time here, so just one more question. Let's see. You mentioned some changes in tax law for those in California. Are there other states that may have important changes coming up? Since we have donors, we have supporters all around the country. Is there anything specific? Perhaps Julie, you may know this answer, or anyone else?
The tax laws I had mentioned were the federal tax limits. So it's the estate tax is a federal estate tax. Certain states do have state estate tax, but that's only like a handful. And California, fortunately, does not have estate taxes. So all of the tax laws I was talking about are federal. So sorry if that wasn't clear.
Okay, got it. Well, again, thank you so much to all three of you for your time and for everyone that has joined us. This is definitely an important topic for everyone. And I can just say, we have certainly been really, really blessed by so many of our wonderful supporters that have thought of Free Wheelchair Mission in their legacy giving, in their planned gifts, and even supporters that maybe we didn't even realize, many times we didn't realize that they had left Free Wheelchair Mission in their plan. So that is just a huge, huge blessing to us. And please feel free and contact us at our office. I'm happy to answer any questions. We'll be sharing all of our panelists' contact information after this, the recording. So thank you so very much to everyone for your time. We really appreciate you joining us. And we'll share the recording in a day or two.
Thank you so
Thank you.
much.
Thank you. Good.
Nice
All
meeting
right.
you.
Have a great day, everyone.
Okay. Bye now.